The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we take a look at the market trade, look at some of the fundamentals behind what is happening, take a look at the charts and more. We are joined by our good friend Mike Zuzolo, Global Commodity Analytics, here with us. Mike, always a pleasure, sir. I hope your week is going well so far.
Doing great. Thanks for having me, Jesse.
Thank you for the time, and I'm very curious to dive in and chat with you here today as we've seen, kind of rounding out the month of February, plenty of pressure in the grain and oilseed markets, and it seemed like every commodity taking its turn, and then we get into the beginning of March and try to maybe have a little bit of a bounce in some of the grains the first couple days of March. But let's just dive in and talk about what you are seeing here as we're getting closer to some of these key March reports coming up. Let's take a look first. I'll pull up a chart on the video feed, the Bloomberg Grain Commodity Index monthly chart. And I think this could set us up real well for our conversation today. So let's revisit and talk about what you've been seeing here as of late.
Yeah, I can't underscore to the listener or the viewer how important these next 10 to 20 days are, in my view, Jesse, because this chart really shows very clearly that the market is ready, in my opinion, to move in a trend-like fashion one way or the other, either higher in maybe 10 to 15% gains or lower in 10 to 15% breaks. And so if we break it down, what you said about February, I can't underscore how important February was, because the middle of February, we were making new 3-month highs in the hard red wheat, on the weather, on the Black Sea grain initiative. And then by the end of the month, we took the hard red wheat down for a 5th consecutive month, soft red wheat leading us, and we went down to a 21-month low in the soft red wheat. And so if you look at this Bloomberg Grain Commodity Index, that is the wheat and the corn really hurting us, and it's the meal and the beans kind of keeping us propped up. But we've coiled, we've formed more energy, and I think this is really the time where, as you said, we not only need a bounce here, we need a low. And I've been talking to clients and subscribers all week long about the term capitulation, where it's an exhaustion. What I want to see here is an exhaustion phase in the longs, and it looks like we're getting there, because we're starting to see crop conditions worsen, not improve. And we heard just this past 24 hours that the United States and Russia met on the sidelines of the G20 in India, and that did not go well. And the Russians essentially said, "You're killing the grain deal." So my hope is that those two things really trump the outside market pressures, the bond yields, the U.S.-China relations, and we take this thing back up, because I think time is of the essence. This chart would suggest that very, very seriously.
You brought up wheat. You brought up the grain deal. We'll switch charts here on the video feed, and let's talk a little bit more just about wheat, because I know you and I have talked about wheat being a leader, whether it be to the upside or downside. So let's dive in a little bit more on the wheat complex. What have you seen the last month or so, and what do you foresee possibly here in the next couple of weeks ahead?
Yeah, the bears in the market have said the Black Sea prices are going down. I can't argue that, but they're going down for the wrong reasons. It's not necessarily because there's a lot of product out there. It's because they don't really want to buy from the Black Sea as we get ready to re-sign or extend this grain initiative on March 18th. If that grain initiative doesn't get extended, freight rates are already starting to move up, especially along the Danube River, where the Ukrainians have used that point to be able to get grain into Romania and keep their export pace at least at 2 or 3 million metric tons a month. But what this chart shows you very clearly, in my opinion, is that you have no hard red wheat premium built into this market. You have no soft red wheat premium built into this market because both are down towards their levels from September, October of not 2022, but all the way down to 2021. In fact, the soft red wheat low recently here this week put us down to around July of 2021 levels, where we made a low on a monthly chart. And that was actually the beginning of the 1.5+ year rally that we've just gotten out of. So I really think this is where the discounted prices show up, not just in the futures, but also in the cash. And one last thing is our Gulf wheat price being around $300 a ton is equivalent now to Russia. And so I think we have done enough damage. And I think the weekly export sales, one of the few bright spots in the weekly export sales Thursday morning, was that we saw the wheat come in with the better than 4 week average of around, I think, 39% or 40%.
Yeah, and I was going to mention weekly export sales too. I'm glad you brought that up. The wheat number, that was a good thing to see. I know quart of beans were a little dismal, down towards the low end of expectations. We'll talk more about that in a second. One thought I want to ask you here with spring wheat. I noticed that is kind of the leader out of the three complexes right now. What are your thoughts with spring wheat? Is that going to be more driven possibly by acreage decisions here in the next couple of weeks ahead, do you think?
Yeah, that's an excellent point about the spreads and about the product markets in wheat. Whereas spring wheat was being treated very kindly by the drought last year in Canada and the northern prairie of the United States, we don't have to worry about that as much. And so I really look to that hard red wheat as the leader to the upside, especially with us losing 6 points in the Nebraska crop and 4 points in the Kansas crop. Or excuse me, 3 points in the Nebraska crops, 4 points in the Kansas, and I think 6 points in the Colorado crop this month of February versus January. So it looks to me weather-wise, we really need to see the hard red wheat shine here, and that would suggest that the hard red continues to gain on the soft red. And I would also say one last thing, agronomically speaking, I just drove from Kansas, western Kansas, all the way over to essentially the Indiana-Illinois border south of I-70. And I've never seen wheat look so good in places like Effingham, Illinois, or Olney, Illinois. And that really was surprising to me because it's greening up, it's big, it's lush. Everybody's coming out of dormancy very, very early. So this is where the weather, the drought monitor that came out this week, it really may mean something to the trade, because hot and dry and west of the Mississippi River is only going to create less harvested acres.
Mike, let's talk about quartered soybeans here. Let's pick up now that we've kind of set a stage with wheat, and talk about what you're seeing when it comes to the quarter bean complexes. I know corn had a few days there where we did some chart damage, and soybeans, we did a little chart damage there right at the end of the month of February. I just wonder your thoughts with how these two markets are looking here as we start the month of March.
Yeah, we're starting to see some slippage in the demand on the export front. And it really makes you wonder why the market has chosen, and this is lead month corn divided by lead month beans divided by lead month corn. The new crop looks almost identical. We've broken out to the upside in favor of the beans. We're going after tightening and rationing beans more aggressively than corn. I put that at the feet of the wheat. I put that at the feet of the Brazilian exports of corn going to China. But if the bean export demand is waning, and we've seen a big drop in Chinese meal prices, I think we've probably hit a top in this bean corn ratio. So if that's correct, Jesse, we got to be on point, because one of two things is likely to happen. We're trying to buy bean acres based upon this chart and this breakout. But what if we need to go back and buy corn acres? And does that mean new crop corn stays the same and November beans drop relatively quickly? And that's what I'm really on point for, especially with the worsening tensions between the United States and China. I just got word this morning that China and the United States tensions and relationships worsening enough that we actually are starting to fish around for other countries to now put Russian-like sanctions on China, because I think we feel like we're going to see China take the side of Russia formally in this war. And I think that would be very, very negative potentially for the commodity complex, especially the soy complex.
Well, and to your point there, and I know we've discussed this and have been watching the geopolitics of everything. And if that were to happen, we already are seeing the relationship between China and Brazil pick up. And one would have to think that China, with Brazil's massive soybean crop, would Maybe head there for some more beans, possibly head to South America for some corn. So to your point, I think there is a lot of concern possibly if we do see some of these geopolitics play out the way you were describing.
Yeah, and this is where, with the row crops in particular, we know we've got problems in Brazil and Argentina. In fact, USDA gave us kind of a pearl in their Ag Outlook forum during its breakout session. They were asked why they were so high compared to the rest of the private trade, like me, when it comes to Argentina. And they said, well, this is as of early February that we're giving you numbers. We did not plan on the drought continuing through February and into early March. And so I think we do have some upside or some support levels that we can hold, but we need to hold those levels because of what you're talking about. And we really don't want to underestimate the power of China and U.S. conditions worsening and relationships worsening. It'd be one thing if we were saying this if beans were at $9, but they're at $15. And I think we really have to keep that in the forefront of our minds.
And I think that comes back to having some sort of risk management strategy in place to try and protect what farmers have on the table in front of them here right now, Mike.
I couldn't agree more. And I'll just put a dot on the I that you just put in there. It's very important if we don't hold these levels this week and we take the earlier week lows out, we break lower on those wedges. I will be running and getting puts bought. I won't be making hedges on the cash side of the equation, especially with the wheat average price at $8.50 by USDA's account this coming year. We're trading $2 below that in Olney, Illinois for summer harvest delivery for soft red wheat.
Mike, let's talk livestock. I'll pull up another chart on our video feed. This is a feeder fat cattle spread chart, and this cattle trade has been interesting to watch. I wonder, is the cattle trade maybe getting a little tired at these lofty levels? I'll throw that at you, and I'll let you also discuss what you see on this chart.
Yeah, it's funny how intuitive you are, Jesse, because we don't talk before the show about what we're going to talk about. But this chart sets us up for the fat cattle market. And what I see in the month of March is getting more simple. And maybe it's wrong, but I tend to try and do the Occam's razor type mindset. If it's the most likely scenario, then take it. And what I see in this market right now is we've had the seasonal where the feeders have lost to fats. That usually happens in the first quarter, second quarter, and then we tend to make a low by the time we get out of the second quarter in the feeder cattle minus the fats. This makes sense from both the cattle on feed report last week and also what I am hearing from producers when it comes to a terrible calving season in some parts of the West, like Nebraska and southern South Dakota. Lots of cows being lost right now, more than I remember hearing in many, many years, whether it's ice or disease or whatever it is. It's just happening a lot more frequently than I remember. So anecdotally, it would make sense that we will not see much go into the feedlots at all this spring, and retention will be very, very strong just because of death loss of the mama cows. So if that's the case, then we have to look at what has been driving the fat cattle recently. And that has gotten more clear as well, if you ask me, and that's been the equities markets. If the Dow Jones and the S&P slips, I've seen it 2 or 3 times in the last 2 weeks where the fat cattle futures slip. And so unless we come in with really strong cash markets again, and the packers should be short bought with those marketings numbers we saw on the cattle on feed report of 104%. But unless we see that, then I think we'll continue to see the fat cattle trade more with the equities markets. And if the equities markets go down in this risk-off mindset we talked about in the grains, I would look for the feeder cattle to be the ones that hold the stability. So fats need the feeders more and more and more. The big question you have is, what if the corn market rallies? How does that work for the feeders? And that is a still to be determined, stay tuned type question.
And with the fat cattle, our live cattle trade, any thoughts with April taking over lead month from February? Now, another chart I'll pull up on the video feed. Can you talk about that a little bit?
Yeah, we still have not seen the April when we went up, and this is a monthly chart. We went up to new monthly highs, new multi-year monthly highs on a closing basis. That big black bar that bounced off the purple line there, the one that's just before the current red bar, the small red bar, that was the month of February, closing monthly high back to April, May 2015 levels. But we couldn't see the cash develop and get up to those prices of 168, 169 area. So we've fallen back to the cash price, and that's what I'm talking about here. This fat cattle market seems very real time with the cash market. So that purple line becomes a really key indicator, especially with the market very, very overbought. The momentum indicators are saying new longs are unlikely to come into this market without a really good reason, especially with the commitment of traders still being absent in terms of data to be able to utilize. And then you throw into that the cycles of those every 6 to 7 year cycles that we see major lows. We're running very long in this cycle high. So a break below that purple line in this chart would mean to me you need to get some hedges in place if you haven't already.
Mike, I'll ask you on the hog market too. I know export sales Thursday morning, it was another strong number. I know it was down from what we saw last week because we had a massive number there. But I wonder if export sales in pork may be helping at least keep the hog market stable on Thursday.
I think so, but I think the cold storage numbers of being up, 19% from last year makes us feel like we're in an ample situation. And China's definitely, at this point, while their prices have recovered some, they're not rebuilding their herd. They're trying to actually, I think, let go of some of their production here. So I think we're in a range-bound trade, if you ask me, Jesse. I've heard of some disease issues. I've heard of PRRS east of the Mississippi River. That's something I'm watching. But I think it really goes back to maybe a range-bound market. And those Mays seems to me maybe hard for the May to get above 95, 96. That looks like the top of the range to me fundamentally. So I think that's where you might want to put some hedges in place, especially with that CME cash index, $6, $7 discount to that May futures last time I looked.
Well, Mike, before we wrap it up here today, run out of time, we'll open the floor to you. Any other final thoughts for us? Anything we haven't touched on you want to mention here today?
The only thing I'd say, Jesse, is this is pretty historic time, and I showed that to the clients and subscribers earlier this week in a blog update where I put about 6 grain charts together, and they all had those same wedges or triangles in them that the Bloomberg Grain Commodity Index had. So sign up for a trial, request it. Say you listen to Jesse's Market Talk when you go to the 2-week free trial button, and I'll send you that blog post so you can see exactly how pretty historic I think these markets are right now.
Well, Mike, I know it's very easy to sign up for a trial and get in touch with you. What's the best way?
globalcomresearch.com. That's globalcom with 2 M's, research.com. And as you said, there's a free trial button. Just give me your name, phone number, and tell me a little bit about what you do, and I'll contact you once after the trial ends, and I won't bother you again if you're not interested.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Thanks for joining us this week. We will talk to you again next week.
Let's hope we're flying higher next week at this time, Jesse.
I hope so as well. That's going to do it for Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.